Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. As we digest this quarter's economic data, it's clear that a remarkable recovery is unfolding around the world. It's vaccine-led, driven by the US but global in nature, synchronized and supported by remarkable levels of monetary and fiscal policy operating hand in hand. Like so much of this cycle, it's moving fast. Biden going on from his $1.9 trillion stimulus plan to his $2.25 trillion infrastructure plan in just a few months. It's also consumer-led. Savings have built up through this lockdown, and that's given a remarkable ability for spending to rebound as economies start to reopen. Finally, China's economy has been something of a miracle, 6.5% larger than it was a year ago despite the COVID virus, particularly strong exports lifting growth in that region as well. So what does this mean for world markets? Well, herein lies the challenges. Prices are rising, delivery times are rising, and inflation is beginning to tick up. We'll look at what the consequences are for our asset allocation, for policy through 2021, and for actions in your portfolio. So let's begin by looking at the COVID data on the left-hand side. These is weekly confirmed cases per 1 million people. The good news is the UK, that was by far the outlier to the upside, is now the outlier to the downside. US numbers again falling too, which is helpful. Germany, I'm afraid, beginning to pick up. Italy picking up but rolling over in the last few days. And look at that surge in the French numbers that's worrying President Macron so much and triggered the new lockdown across France. On the right-hand side, I've shown the stringency index numbers, 0 the position pre-crisis, 100 maximum lockdown. Again, the UK in dark blue, which was the tightest lockdown in the world, beginning to ease off, Italy taking its place, France tightening, US beginning to ease off as well. Let's also look at those economic numbers in more detail, country by country. I've shown here for 2020, 2021 and 2022 the GDP growth projections with our previous numbers in brackets. The most remarkable number is the US, rising from 4.1 to a red-hot 6.7% projected growth rate on the back of Biden's stimulus program, followed through by his $2.25 trillion infrastructure program that will go before Congress shortly. That's contributed to an upgrade in world growth from 5.5% to 5.9%. If you look on the right-hand bars there, to get a number like that, you've got to go right back to 1973. In fact, Biden would probably like to go even further back to the 60s, Lyndon Johnson, the Great Society program, as the model perhaps for the policies that he's putting in place for the US economy. Drilling down region by region, the US is extraordinary. The Biden, Powell, Yellen team really looking to replace all of the loss of growth from COVID by Q2 2021. I've shown here the GDP growth trajectory in light blue. You can see back in 2008-9 that permanent scarring. This time round in 2020, 2021, that line rebounds past above the yellow long-term trend to take us growth rates actually higher than the previous predicted trajectory. On the right-hand side, how have they done that? Well, by pushing up disposable income, particularly through these paychecks that have gone into every American household's bank accounts. And you can see their US disposable income now actually higher than it was pre-crisis. The second remarkable region is China, 6.5% larger than a year ago, despite COVID. Incredible. You can see that in the fixed asset investment numbers, industrial production, retail sales, all bouncing very strongly. That light blue line on the right there, the Chinese trade data, is export data in percentage terms, up an extraordinary 60% from a year ago, as China pumps out electronics, PPE equipment and work from home technologies for the global work from home economy, which is surging. That's pushed the trade balance up to 103 billion, the highest on record. Finally, the UK, a slower recovery. Obviously, we had tighter than expected lockdown in Q1, and we're not expected to replace those COVID losses until late 2022. We're doing it really by running a very high public sector deficit, supporting through furlough and other programs distressed businesses and employers. You can see public sector borrowing around about 16% for the year to date, rising in debt to GDP terms over 100%. What's encouraging, though, is those business surveys are beginning to improve. A number higher than 50 suggests expansion, and I particularly draw your attention to the red line. That's the services index, which was so ravaged by COVID, bouncing nicely up to 56.8. So what does this mean for financial markets? Well, on the one side, it's very encouraging for dividends and profits, and that's driven equities higher. For a UK investor, the world index up 3%, beaten this time by the UK index up 5.5%. But the pricing pressures are worrying bond markets, and you can see UK gilts falling sharply, down more than 7% for the year to date. If I plotted that for the US bonds, that would be even larger. In fact, it would be the worst quarterly return since the 1980s. Let's look at history though as well, and I've shown here the big US bear markets from 1929 right to 2020. And you can see in red line the 2021 numbers, not only the shortest and sharpest bear market, but look at the speed of the recovery. So what are we doing about this in policy terms? Well, for bond markets, we're moving even further underweight. We're just worried those yields are going to tick higher, and we're highly dependent on continued central bank purchase. So a miscommunication, as we saw in the taper tantrum of 2013, very possible. Retaining our overweight to equities, moving a little more to mid-cycle stocks, food, insurance, utilities, and even banks that can prosper in a mildly tighter bond market environment. Alternatives keeping our overweight in renewables and infrastructure, but adding to our gold positions after recent weaknesses. We're not yet prepared to go for the Bitcoin and cryptocurrency areas. We're worried about security of title and security of the structures in which they're held, and running a cash underweight. So I hope that's helpful. It gives you an idea of this extraordinary, exceptional recovery unfolding around the world, which is so needed for the emerging market workforce, for minorities, and for all those low-paid workers around the world who suffered so much in this crisis. Thank you.